Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Intel stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 154 billion market cap. They're trading at $37 a share and they have 4.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. This doesn't look so good. It was 21 billion in 2020, down to 10 billion in 2021, which is not too bad. It's a big drop, but 10 billion is still a pretty big number. Then negative 10 billion in 2022, then negative 16 billion in the trailing 12 months. The reason they have negative free cash flow is because their revenue is going down a lot, plus they're investing a lot back into CapEx. They're trying to grow their foundry business. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was 21 billion in 2020. Then it goes down more than 50%, a little over 8 billion in 2022. Negative in the trailing 12 months. Revenue is the sales for the company, and that peaks in 2021, their highest ever, 79 billion. Then it gets slashed in 2022 to 63 billion, slashed again to 54 billion in the trailing 12 months. But their revenue in the second quarter of 2023 did go up when you compare it to the first quarter of 2023. So this may be a good sign to buy the stock. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 247 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $192 billion. We divide that by 4.2 billion shares. And we get a calculated stock price of $46. They're trading at $37, so they're trading at a 20% discount. It's a buy according to the model. I am assuming they're going to have positive free cash flow in 2024. Their revenue is projected to plateau this year and start to increase again next year. There are 62 companies in the semiconductor industry, and if Intel has a number in red, they're worse than the median. If they have a number in blue, they're better. Intel spends a ton in CapEx. 28 billion. The only company that spends more is Taiwan Semiconductor. Taiwan is the largest foundry in the world. Foundry semiconductor companies manufacture the chips and wafers for fabless companies. The largest fabless company is NVIDIA. Fabless companies outsource the manufacturing to companies like Taiwan Semiconductor or Intel. Intel's debt to equity ratio is average. For every dollar of equity, they have 50 cents of debt. They pay the highest dividend, over 4%. They're by far doing the worst in free cash flow, a really big negative. Most companies are positive in this industry. Micron also has a big negative. They rank 6th in market cap. 20 years ago, Intel was the leader by far. They've fallen far down the list. They have a really good price to book and price to sales, better than the median and average, but we can't look at their PE or price to free cash flow since they're negative. They generate lots of revenue, a lot higher than the median and average, double NVIDIA's, but less than Taiwan Semiconductor. They're second in revenue. From the 1990s up until last year, Intel generated more revenue than any other semiconductor company. Until this year, now Taiwan Semiconductor is first. A few years from now, I would expect NVIDIA to have more revenue than Intel. And the reason Intel stock price is coming down is because their revenue is declining. Their 5-year annual revenue growth rate is negative 3%. Look at AMD, 32%. That's the highest on this list. NVIDIA is at 19%. Intel released their earnings the other day, and they beat revenue by 7%. They beat earnings as well. Their expected earnings was negative 3 cents. They reported 13 cents. So it's not a 500% increase. If this number was 3 cents, then 546% would be correct. It's negative 3 cents. So you can't do the calculation. But that's still a great result. The expected EPS was negative 3 cents. They actually reported positive 13 cents. Their expected revenue was 12.1 billion. They reported 12.9 billion. They also did well last quarter, beating earnings and revenue. The quarter before that was terrible. The third quarter of 2022, they beat earnings and revenue. Let's take a look at their second quarter earnings. Second quarter revenue of $12.9 billion, down 15% year over year. So that's down 15% from the second quarter of 2022. Although the second quarter results on the top and bottom line exceeded high-end guidance. Top line is revenue, bottom line is net income. It's referring to the income statement. They're forecasting third quarter revenue of $12.9 to $13.9 billion. So even in the worst case scenario, their third quarter revenue should be higher than their second quarter revenue. They're projecting third quarter EPS of 4 cents. The CEO said we are well positioned to capitalize on the growth in AI. Let's go through their income statement. Revenue of $12.9 billion. Let's get a breakdown of this number so we know what it is. Of the $13 billion of revenue, $7 billion is client computing, $2.4 billion desktop, $4 billion notebook, $500 million of other. When it says notebook $4 billion, that means they sold $4 billion of semiconductor chips that went into notebook computers. Data center and AI, that's $4 billion, down from $4.7 billion. Network and edge, $1.4 billion, down a lot from $2.2 billion. Mobileye, $450 million. Intel acquired Mobileye for $15 billion in 2017. Mobileye develops autonomous driving technologies and advanced driver assistance systems. This includes cameras, computer chips, and software. Even though Intel acquired them in 2017, they are a separate company. They went public in 2022. The ticker is MBLY. If you want to buy a share of Mobileye, it's $38. Their market cap is $30 billion. You can see the stock has done well since they IPO'd. It looks like they IPO'd in the high 20s. It almost got to $50 in the beginning of 2023. Now it's at 38. So it's up about 40% since they IPO'd. Let's go back to the income statement. They generated $230 million from their foundry business. That's up a lot. It was $57 million last year. That's going to grow a ton because they're investing a lot into that business. That's where most of their CapEx is. All the expenses directly related to generating the $12.9 billion are $8.3 billion. This includes payroll, all the costs to make the chips, the rent at its factories. Revenue minus cost of revenue gives you your gross profit, $4.6 billion. It was $5.6 billion last year. One of their biggest expenses is R&D, $4.1 billion. Marketing, $1.4 billion. So their operating expense is $5.7 billion. They have an operating loss of $1 billion. Let's get a breakdown of the $1 billion. They are profitable in client computing, $1 billion. That's their biggest revenue generator, $6.8 billion in client computing. They're also profitable in Mobileye, $129 million. But they have a loss in every other category. That's why they have an operating loss of $1 billion. Their income before taxes is negative $800 million, but they have a tax credit of $2.3 billion. That gives them positive net income. So their EPS for the quarter is 35 cents compared to a loss of 11 cents. They are adding shares. They had 4.1 billion last year. Now they have 4.18 billion. Let's look at their balance sheet. Current assets of 43 billion. Current liabilities of 27 billion. So their current ratio is about a 1.6, 1.7. They have 8.3 billion of cash, 16 billion of investments. So about 24 billion of cash on hand. Short-term investments are pretty much considered cash. 3 billion of accounts receivables, that is down from 4.1 billion. They have lots of inventory, 12 billion. Since they're a manufacturing company, inventory is broken up into raw materials, work in process, and finished goods. More than half their inventory is work in process, 6.6 billion. They have lots of PP&E, 90 billion. That's up a lot from last year of 80 billion. 28 billion of goodwill. Goodwill comes from acquisitions. So total assets, 185 billion, up from 182 billion. They have lots of debt, 46 billion of debt. That's up from 38 billion from last year. But they are a really profitable company. Their retained earnings are 67 billion. That is down from last year of 70 billion. Retained earnings is the sum of all your prior net incomes minus the sum of the dividends you paid out. And they raised 34 billion from selling their business. Common stock and additional paid-in capital is the money the company raised from issuing stock. Let's look at the statement of cash flows. This is for the trailing 6 months. Even though they had negative net income, they still generated $1 billion of cash flow, which is down a lot from last year of $6.7 billion. In their investing section, they spent $13 billion in PP&E, last year $12 billion. In their financing section, they added $11 billion of long-term debt. They paid out $2 billion of dividends. Last year, they paid out $3 billion. They've done 6 stock splits. The last one was 23 years ago, back in 2000, a 2-for-1. But you can see they grew a lot in the 90s. 4 of their 6 stock splits were in the 90s. If you invested $10,000 into this company 10 years ago, you'd have $21,000 today. That's an 8% annual return, a 111% total return. Let's take a look at the company on Simply Wall Street. It's last trading at $37, $150 billion market cap, up 8% in the past week, up 1% in the past year. Let's learn a little more about the company. They design, develop, manufacture, market, and sell semiconductor chips. They operate through multiple segments: client computing, data centers and AI, network and edge, mobile AI, accelerated computing systems and graphics, their foundry business, and other. They offer CPUs and chipsets. They also offer boards and systems, connectivity products, and memory and storage products. They sell their products to retailers, healthcare companies, also companies involved in autonomous driving, computers and machine learning companies, the mapping industry, and a bunch more. They're involved in cloud services, enterprise and governments, and communication service providers. They sell to OEMs, original design manufacturers, cloud service providers, and other equipment manufacturers. They were founded in 1968 and headquartered in Santa Clara. Here's their stock chart since 1990. They peaked in 2000 at $74 a share, and they never got that high again. They fell below $15 in 2009, but they did run up a lot, getting over $60 in 2021. But ever since that peak, the company's stock price is down a lot. It fell to below $20 this year, but it is creeping back up. Simply Wall Street's valuation is $46. They say the stock is 19% undervalued. 38 analysts priced this stock and the average price target is 34. They say the stock is 6% overvalued. You can see their revenue grew from 2012, it was $54 billion, up through 2020, close to $80 billion. But you can see it took a real dive starting in April 2022. Their revenue is down about 20%. It's currently at $54 billion for the trailing 12 months. But the forecast is for their revenue to grow to $63 billion by 2025. Back in 2012, they had debt of $7 billion, cash of $10 billion, equity of $49 billion. So their debt to equity ratio was 15%. The red line is their debt, and you can see it's gone up over the years. Their current debt to equity ratio is 47%, $49 billion of debt, $104 billion of equity. But they do have a lot of cash, $24 billion. In 2013, they were paying 90 cents in dividends. That's for the entire year. And they grew that each year up through 2023. And they're forecasted to cut their dividend quite a bit this year and next. They've always had a pretty healthy dividend yield. It was 4.2% in 2013, 2.4% in 2021. And since the stock price has been coming down, the yield has been going up. It was over 5% in 2022. The forecast is for the yield to be 2.3% by 2025. The CEO's salary is $1.3 million. Their tenure as CEO is 2.5 years. In the past year, there's been lots of insider buying, very little selling, so that's a good sign. 63% of the company is held by institutions, and 37% by the general public. The biggest shareholder is Vanguard at 9%, 373 million shares valued at $14 billion. A positive sign is when a company's employee count is increasing. They had 105,000 in 2012. They're up to 132,000 currently. You can see their ticker trades in lots of places. The Nasdaq, Lima Bolsa, Mexican Bolsa, Swiss, Deutsche Börse, Hong Kong, Xetra, Santiago, EuroTLX, Wiener Börse, Brussels, Kazakhstan, Bulgaria, Santiago, the BATS Europe, Buenos Aires, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.